Let's get some insights and some knowledge from Richard Saperstein. He's Chief Investment Officer over at Treasury Partners, which manages $9 billion for clients. And Richard, always wonderful to get your thoughts. And I do want to get your broader thoughts here on the idea of kind of this, for lack of a better word, uncertain environment we're heading into, whether it's the idea of higher rates, whether it's concerns about the economy, or whether it's the geopolitical issues brewing over there in Russia and Ukraine here. How do you sort of talk to clients through this type of environment where so little is known about what's ahead?
Well, 22 will be a year of uncertainty and increased volatility. We've had 3 solid years of equity market returns. Market's up basically 100% over 3 years. Now we have a Fed that's going to start pulling away the punch bowl, and we're going to have much more volatility, and investors have to experience that. But in the end, we still have a very strong economy. We've got reduced unemployment that's going to occur throughout the year, and the global tensions, they're going to add to the volatility.
How are you thinking about the long-term path, though, higher and the ability of this Federal Reserve to maintain some of the inflationary rates that we've seen?
Well, if we go back 40 years and look at Fed tightenings, there's been 4 episodes with the Fed funds peaking at 9 3/4 in 1990. The last high after that was in 2000 at 6.5%, then at 5.25% in 07, and then the last high was at 2.5% in 2018. So we have to ask, why can't the Fed move the Fed funds rate to higher highs? They've only been able to do it to lower highs each successive tightening, and that's what we think is going to occur now. The reason, in our view, that the Fed is restricted from really jacking the Fed funds rate up above the last high is because of the advent of more federal debt. If you look at what's happened in the last 3 years, GDP has grown from $22 to $24 trillion. However, federal debt has gone from 23 to 29 trillion. As a result of that, the marginal return on debt through GDP growth is less than the increase in debt. So that dampens the ability of the Fed to really hike rates. So our view is that the Fed's going to tighten. There's going to be market volatility. However, the Fed is not going to be able to pierce that 2.5% on this tightening regime.
So say we hit more volatility ahead. What are clients doing to be hedging right now? Are they buying volatility? Is that too expensive? I mean, how do you protect yourself, Richard, in this market?
Well, this is an environment where you don't want to try to be a hero. And we're advising our clients that we try to lean into risk during environments where there's an attractive reward in light of that risk. In this environment where there's so much Fed uncertainty, inflation uncertainty, geopolitical risk, it's best to hang back and take a more conservative position. So what does that mean? Well, on the fixed income side, we've shortened our durations and we're not extending maturities in mandates that allow us to go out longer term. We're still keeping maturities short. But for shorter mandates on the fixed income side, let's say a 5-year max, the front end of the curve is actually very, very attractive because of this Fed mania right now.
Well, I'm glad you used the word mania, because I do wonder at times. I mean, obviously on this show we have to kind of deal with some of the day-to-day moves here, but I wonder if maybe some folks are making a little bit too much of this. I mean, it's one thing to sort of reposition around what you think the reality is going to be. It's another thing to just throw the entire baby out with the bathwater.
Agreed. We're not going to get 7 tightenings in the next 18 months, and the Fed is not going to be turning from a very, very passive, market-concerned Fed to one super aggressive like I grew up with starting in the Volcker days 40 years ago. So we're going to expect some tightenings. We expect them to utilize QT to augment Fed policy. But we just don't think that we're going to see a super aggressive Fed look to deconstruct market performance. So at this point, the Fed will tighten. But, you know, it's kind of strange. They're going to go from QE
right.
ending in March, and all of a sudden they're going to start tightening. Hard to say.
You know, Richard, we're laughing because I do my daily reminder that we're still in unlimited QE right now. We're still buying bonds for the next month. Why are we doing that?
Well, again, this goes back to a very cautious and moderate Federal Reserve. It is not the Fed that I grew up with, where the Fed would call a meeting and basically announce we've stopped QE and we're tightening. But this Fed is going to finish out the bond buying through March. Maybe they'll tighten. But either way, investors have to realize that this is going to be a very choppy market, and they've got to be cautious with their positioning.
Richard, can you be even more specific here? Does cautious mean selling? And if you are selling, what are you selling?
Okay, so for months we've been talking about avoid zero coupon stocks and zero coupon bonds. On the bond side, shorten duration, okay? On the stock side, companies that are burning cash are the ones that have gotten stung the most in this cycle. Conversely, companies that have super high cash flows as a percentage of market cap have been the beneficiaries. A lot of that is large cap tech. So look at an Apple with $110 billion of operating cash flow and roughly $100 billion of free cash flow, or Microsoft, $83 billion worth of operating cash flow. So buy cash flow right now. At the same time, a great geopolitical hedge is going to be the oil companies, obviously, with what's going on in Ukraine and with Russia. But the oil companies also have the added benefit of completely turning around their operating structure, where prior couple of years, they were actually negative cash flow, and now they're generating roughly 8 to 10% of operating cash flow. Yeah. So it falls into that category.
When we talk about, more importantly, the cash on the balance sheet, Richard, and the idea that a lot of investors, of course, want that cash back to them. In the past, we know that stock buybacks have been the primary way of doing that. I've heard a lot more people talk about the importance of dividends in the current environment that we're heading into. Is there one that you favor over the other?
Well, the current return of the S&P to shareholders is averaging 3.6%. And we always look at that versus the 10-year Treasury. So you got 3.6 versus 2%, which obviously favors large equities in the S&P. So we believe that with companies that have elevated free cash flow, they're going to increase the stock buybacks and their divs. So it's only going to be a better return on capital to shareholders. And that's going to be a benefit in 2022 in this period of market volatility.
Really appreciate your broad-based wisdom, guidance, of course, on these markets, and big job ahead for the Federal Reserve. Richard Saperstein, CIO of Treasury Partners.